With the participants are joining. And so what I'll do, I'll minimize my screen after the introduction. Right.
Yeah. Okay. Well, unless you want to come on and
at the end.
Yeah.
Okay, we've got about 50 now. How about we kick off in the interest of time. Good afternoon, everyone. Welcome to the FSAA's webinar for today. As you know, in these uncertain times, we've had to change tack a bit and had a series of webinars, and hopefully you find today's extremely useful. I believe it's our first economic update, and we're extremely privileged to have an esteemed guest here today, Saul Eslake. Before we get into that, I'd actually like to just say thank you to Di Litherland for putting us in touch with Saul, and really appreciate the opportunity that this has made for our members. As a brief introduction to Saul, you've got a huge rap sheet. I could actually use up our time going through it, but I'll touch on some of it because I think it's really important so that our members know you. Saul is an independent consulting economist based out of Hobart, and also a Vice Chancellor's Fellow at the University of Tasmania. He has a number of other roles as a member of the Parliamentary Budget Office, as expert advisory panel, the ATO's tax gap expert panel, and the advisory board for Jamison Coote Bonds, which is a Melbourne-based bond manager. He has a series of other roles, previously as the chief economist at National Mutual Funds Management, the chief economist at ANZ Bank, director of productivity growth program at the Grattan Institute. And I'm not doing you justice here, Saul. I think what was interesting, I noted in the profile that you have at a number of times been a member of the Rudd-Gillard government's National Housing Supply Council and the Howard government's Foreign Affairs and Trade Policy Advisory Council. Really impressive, and it's thank you for joining us today to touch on this complex subject. Speaking about an economic update, it's complex at the best of times, let alone during a pandemic, and so we're really fortunate to have your expertise here today to go through this subject. In terms of the plan for this webinar, what we have is Saul will go through his webinar and slides, and then at the end of we'll have an opportunity to go through any Q&A questions that you may have, which you can please kindly put in the Q&A text. We'll go through it at the end of the session. So without further ado, over to you, Saul, and thanks again for joining us in this session.
All right, thank you, Stephen, for that introduction, and good afternoon to everyone who's joining us in this webinar. It's nice to be able to talk to you. As Stephen said, I'm coming to you from Hobart. I was saying in the chat beforehand that I haven't been on a plane since February this year, and that's the longest I've been without the joy of flying somewhere since, I think, 1985. But in the meantime, become, as probably lots of you have, much more familiar with this sort of technology. So hopefully we won't have any of those sort of glitches that inevitably you do when you're first learning how to use things like Zoom and Teams. But what I'm going to do, if I have learned to do it properly, is to share my screen so that I can do this presentation and you can follow along with my slides. So that does all seem to be working reasonably well. Here's what I hope we're going to do today, just a very brief agenda by way of summary. That first of all, I'm going to talk a little bit about the virus itself. I'm not an epidemiologist and I'm not going to pretend to, but as I've learned, you can't really get a handle on what's happening on the economy and the way governments are responding to it in ways that will affect the economy without having some idea about how much havoc the virus is wreaking and how we're progressing in the battle to contain it and to prevent it from taking off as many people as it has. I'm going to say a bit about the world economy. Obviously, Australia is influenced by things that happen in the rest of the world, at this time no less than any other. I'm not going to go through a whole lot of individual countries. I can do that, and I'll share with you at the end a way in which, if you're interested in what I think about individual economies, you can do that.
Sorry to interrupt you, Saul. Sorry to cut you off there. We don't have your slides on screen at the moment. Could you try that one again, please?
Okay. I don't know why that happened, but let me try it again.
That's better. Thank you.
That's better. Okay. Well, thank you for telling me that. Let me just put it on presentation. So you've got it there now?
Yeah, that's perfect. Thank you.
Good. Excellent. Okay. Well, thank you for that. So much for saying, hope I knew how to use the technology after all that practice, and you still get tripped up from time to time. So after talking about the world economy, the detail of today's presentation will be in my look at the Australian economy, how that's tracking and what the outlook for it is. I'll talk a bit about the response of the Australian government, briefly state and territory governments and the Reserve Bank to that, and then talk a bit about the path out of the hole that we're currently in. And hopefully at the end of that, I won't have answered all of your questions and that you'll have some to put to me so we can have a bit of discussion. But before we do get into that, let me make one final observation which is important in this context. Nothing that I'm about to say over the next hour or so constitutes investment advice, nor should it be construed as such. And if you think by some chance something I have said does represent investment advice, then to paraphrase something that former Fed Chairman Alan Greenspan used to say, you almost certainly haven't understood what I said. And just to underscore that, I don't work for a big bank anymore, so there's not much point in suing me if you mistakenly think I've offered you some investment advice and you end up losing your money. But given the business you're all in, I'm sure you understand all of those risks and also the reason why I need to say something like that. So let's turn to the subject at hand and talk very briefly about the virus. And I guess the point I want to begin with here is that we haven't got this under control globally. The second wave still hasn't peaked. The number of cases is approaching 30 million. I suspect we'll have crossed that threshold over the coming weekend. And the number of people who've died of COVID-19 is now, as of yesterday, only 50,000 short of 1 million. And I suspect we'll cross that threshold at some point in the next 10 days or so. The current second wave hasn't been quite as deadly as the first wave has been. That is, although the number of new cases is continuing to climb, the number of new deaths has been reasonably stable since the end of April. That might be because the second wave is catching more relatively young people than the first wave did. And we know that it isn't as fatal among young people as it is among people in their 60s, 70s or over. It's also the case that health professionals are learning more about the virus almost on a day-by-day basis, and so they've been better able to tailor their treatments to saving lives than they were in its early stage. It's also possible that the virus itself is mutating in ways that make it no less infectious, indeed possibly more infectious, but perhaps less fatal than it was during the first wave in March or April. I had for some time been focusing on about 9 countries with 33% of the world's population who at one stage in mid-August were accounting for almost 3/4 of the new cases. That proportion has come down to about 2/3, but the number of cases is still rising in what I call here the 4 I's, that is India, Iraq, Israel and Indonesia. The number of cases appears to have peaked in countries like the United States, Brazil, Colombia, Mexico, South Africa, Saudi Arabia, Russia, where it had been of concern, but in those 4 countries who just happened to start with I, the numbers are still rising. And more recently, although I haven't shown it in this chart, the numbers in Europe have begun to increase significantly, perhaps as their summer holidays are drawing to an end and people are starting to get back to work. But some European countries now seem to be experiencing something a little like what Victoria has been experiencing since the end of August. Here in Australia, the number of cases has declined quite markedly, and in the past week is likely to have been the lowest it was since the last week of June. The number of deaths, of course, has still been rising because deaths tend to lag by 2 or 3 weeks from infections. That's the way the virus works. But as you can see, we had a fairly nasty second wave of the virus. That was, of course, very much concentrated in Victoria, and to a much lesser extent in New South Wales. The other states and territories really haven't had a second wave at all. New South Wales has done a pretty good job of preventing what happened in Victoria from spreading to that state, if it had done, given that New South Wales is, of course, Australia's largest state economy. The consequences for the Australian economy as a whole would have been even more dire than the consequences of having a second wave and a lockdown in a state that represents 25% of Australia's economy have been. Now, I could go on about what I think are the reasons for the second wave having occurred in Victoria, but that would probably take me a long time, and most of you probably know that anyway, so I will move on. Just to note that horrible as the second wave in Victoria has been, our overall infection and fatality rates remain pretty low by international standards, as they also have done in New Zealand and in most East Asian countries, with the exceptions of the Philippines and Singapore. Although the proportion of cases which have resulted in deaths in Australia has crept up over the course of the second wave to be about in the midpoint of the 25 or 30 countries that I show there. That's largely because of the number of cases that have occurred in Victorian aged care homes, whereas we know the fatality rate is much higher than it is in the broader population. But if you look at the number of cases per million population or the number of deaths per million population, it's still the case, as it was at the end of the first wave, that Australia has done a pretty good job by comparison with other countries in managing the spread of the virus. And we've been able to do that without having, outside of Victoria in particular, anywhere near as harsh restrictions for as long as many other countries have done. As I say, we've crept up that table of countries by the severity of their restrictions over the last 6 weeks, but still we haven't been as strict as many other countries, both in the emerging world and in the developed world, have been. So let's have a quick look at the world economy. As I say, I'm not going to talk about individual countries much here, but just to give you a global backdrop before we move on to look at Australia. Of the 95 or so countries that publish quarterly national account or GDP estimates, 65 or so of them have now reported, and based on what they say, the contraction in world economic activity over the year to the June quarter looks like being about 9.8%, and that is worse than anything that has occurred in at least the last 40 years for which it's possible to compile quarterly world aggregates. In reality, it's almost certainly the worst that it has been since the Great Depression of the 1930s. That is almost 90 years ago. And if we look at the countries that have so far reported their results, you can see that quite a lot of them have done much worse than Australia has done. That yellow column over on the right is Australia, which shows our economy declined by 6.3% over the year to the June quarter of 2020. There are really only about 10 other economies that have done less worse than us. There are only 3 that reported positive growth over the year to the June quarter, and one of those was China, which of course reported very negative growth over the year to the March quarter, because that's when they experienced it. At the other end of the spectrum, the most severe recession in the world has been in Macau, where GDP is barely half in the June quarter of this year what it was in the June quarter of 2019. That's because just about the only thing that Macau does is gambling, and that's been severely restricted by both the Hong Kong and the Chinese authorities. But aside from that somewhat rather special case, you can see countries like Peru, where GDP contracted by almost 30% over the year to the June quarter. India, Spain, the UK, where it contracted by more than 20% over the year to the June quarter. And something like 35 countries where the economy contracted by between 10 and 20% over the year to the June quarter. As a crude generalisation, and there are some exceptions to this, the extent of contraction in economic activity is closely related to the success or lack of it that countries have had during this period in dealing with the virus. And that serves to remind us that really, until we get on top of the virus, or alternatively, until a vaccine is produced in sufficient quantity that most people can take it, that's proved to be safe and works, until either of those two things happen, there isn't really going to be a sustainable economic recovery, and economies are going to remain at risk of setbacks from renewed outbreaks of the virus that force governments to reimpose restrictions, as they have done in Victoria, as they have done this week in Israel. And if you've been listening to the radio in the last 24 hours, you'll see they've started to do in parts of England and parts of France, among other countries where this has been an experience. All of the world's major international forecasting agencies are saying that 2020 is going to be the worst year for the global economy since the 1930s. The OECD this week issued revisions to the forecasts it had previously made in June. They revised up their forecasts for 2020, which is to say they made them less negative than they had been in June, but they also revised their forecasts for 2021 down a bit, reflecting a greater recognition on their part, I think, than they had back in June, that the prospect of a V-shaped recovery out of this hole is, I think, diminishing, and that the path out of the recessions that virtually every country in the world is now in is going to be rather more slow and gradual than the path into it was, which, as we all know, was pretty sudden and dramatic. Partly because this is the world's worst recession since the 1930s, governments around the world are generally doing more by way of fiscal stimulus than they did, for example, during the global financial crisis. And some of them, including Australia, did an awful lot during the global financial crisis, but they're almost all doing a lot more than that, even though virtually every government in the world is going into this with their balance sheets, their levels of public debt, in a worse position than they had been going into the global financial crisis. And not only are governments doing more, but central banks are doing as much as they can, and in some cases more than they did during the global financial crisis. Obviously, those central banks who cut their interest rates to zero, or indeed even into negative territory during and after the financial crisis, haven't been able to do a great more by way of cutting interest rates. The US Federal Reserve and the Bank of Canada, which had increased their interest rates during 2016, 2018, when their economies were starting to look healthier, have unwound all of that during the period since the onset of the pandemic in March. In passing, I think it's instructive that those countries whose central banks had instituted negative interest rates during the last 4 years, that's the European Central Bank and the Bank of Japan in particular, haven't thought it necessary or desirable to make interest rates even more negative as the pandemic broke. I think that probably tells you something about whether negative interest rates are actually an effective idea or not. In my view, they're not. They cause more distortions to and damage to the financial systems at times when you actually want the financial systems to be functioning well than they actually do any good. But of course, as they discovered during the financial crisis, interest rates aren't the only tool that central banks have at their disposal. They can also undertake what's come to be known as quantitative easing. That is, for example, buying large quantities of government bonds, in part to pull down longer term interest rates that serve as the benchmark for fixed rates for lending to corporates, and in particular in the US to households, where most mortgages are at fixed rates. That obviously also helps governments finance their debts by keeping down the interest rates they have to pay on the much greater borrowings that they have been undertaking. And in many countries, including Australia, the central banks have also started making cheap money available to banks so that they can in turn lend it out to their customers who might need it at relatively cheap rates. And although this hasn't happened in Australia, in some other countries, including Japan and the United States and the Eurozone area, central banks have been buying private sector financial securities such as corporate bonds, or lending directly to firms who might otherwise have had difficulty borrowing from their banks. So central banks have tried to be as creative as they can be in finding ways to support economic activity generally, and to assist businesses and households to cope with the circumstances that they've been forced to confront. One of the things that central banks will usually acknowledge is they don't necessarily fully understand how all of these tools work, but they just hope that they do. And there is certainly some evidence that they do. In particular, many of the things that the Federal Reserve and other central banks did during the second half of March were crucial in preventing what looked at one stage to be developing as a rerun of the global financial crisis. That is, a meltdown in some of the markets that are important to banks in the way that they fund themselves so they can lend to their customers. We saw a surge in the US dollar as people sought that out as a safe haven. And if that had continued a lot, that wouldn't have been good, especially for emerging markets who have lots of US dollar denominated debt. So what central banks have done has certainly been helpful, but as they themselves would say, there are limits to what they can do, which just underscores the importance of fiscal policy, that is what governments can do with their budgets, as crucial to helping us get through the shutdown period and then to underwrite some sort of sustainable economic recovery once we do, as hopefully we will, get on top of the threats posed by the virus. Some people have noticed that the quantitative easing that central banks in the major economies have been doing has prompted a much more rapid acceleration in money supply growth than it did during the global financial crisis. For example, if you look at money supply growth in the United States over recent months, that's actually been the fastest on record back to at least 1960. Similarly in Japan, where they've been trying to generate faster money supply growth since their bubble economy burst at the end of the 1980s, all of a sudden in the last 3 months, they've had the fastest money supply growth they've had since the early 1990s. Part of what's going on here, of course, is that unlike the global financial crisis, when the financial system itself was close to busted and banks weren't willing to lend, and people were in many cases reluctant to deposit money with banks for fear that they wouldn't get it back. The financial system in most economies now is functioning something close to normal, as it needs to. And indeed, a lot of the acceleration in money supply growth that you can see in these charts that began in March was big companies in particular drawing down on uncommitted lines of credit that they had with their banks in case they needed it during a period in which they thought they wouldn't be generating any revenue. And because they didn't immediately need it, deposited back with the banks that they borrowed it from. And that's what drove some of the big increases in money supply during March, April and May. And in fact, those monthly growth rates have begun to slow down since then, as big bank customers have concluded that they actually didn't need all that money they borrowed, partly because they've been able to get money through government subsidy programs, and hence money supply growth on a month-by-month basis has actually begun to slow down, even though that isn't apparent yet and won't be for a few more months in the 12 months two measures of money supply growth that I've shown here. Of course, there are folks around who think, because that's what they were taught in economics degrees in the 1970s, that money supply growth means higher inflation, so they go out and buy gold, which is why its price got up to record highs a few weeks back. But when you look at the inflation numbers that are being reported in the major economies that I've shown here, or indeed most other economies as well, there's no sign at all that inflation is picking up in any meaningful way. I mean, in the US, core inflation ticked up a bit in July and August. Some of that was higher prices for used cars that people all of a sudden are eager to buy because they don't want to use public transport anymore and can't afford to buy a new car. But if you look at most of the other economies, central banks are undershooting their inflation targets as much in recent months as they had been for the past 4 or 5 years. And so you now see central banks like the US Federal Reserve starting to say, well, if we ever succeed in getting inflation back to 2%, we might actually let it run for a bit higher than that, to say 2.5 or 2.75% for a while, just to make up for some of the ground that we have lost. Let me now, however, turn to look at the Australian economy. And of course, here the key message is that the record-breaking run of nearly 30 years without a recession, defined in the conventional way as consecutive quarters of negative real GDP growth, has come to an end. And I always thought that was a pretty silly definition, consecutive quarters of negative economic growth. I mean, just to illustrate that, suppose that the bushfires hadn't happened in Victoria, New South Wales and South Australia at the end of December and beginning of January. That might have meant that March quarter GDP was plus 0.3 rather than minus 0.3. But if that was so, and we still had the 7% decline in real GDP that we had in the seventh quarter, would you really want to tell anyone that we weren't in recession because we hadn't had 2 consecutive quarters of negative growth? As I say, it's a silly definition, but it's the one that everyone uses. And by that definition, we're now in one for the first time since the early 1990s. And this chart, which looks at the components of GDP in a bit more detail, tells you why. It was because we had a huge decline in discretionary consumer spending in the June quarter, and to some extent a decline in so-called essential consumer spending as well. But that was mainly because people couldn't get out and spend. And even if they could, they were a bit apprehensive about spending for fear that they mightn't have a job to go back to when all the restrictions were over. So as it turned out, most of the drop in wages and salaries and in other forms of income, business income, that occurred because of the shutdown in the June quarter was offset by government payments, JobKeeper, JobSeeker, and those sort of things. But because people couldn't spend or didn't want to spend that income, the proportion of household income that was saved shot up to 20%, which is the highest it had been since the June quarter of 1974. And not surprisingly, business investment was down, although in passing, it's worth noting that even in the June quarter, mining investment held up. The mining sector, for what it's worth, turned the corner in 2019 after 5 years of digesting the peak of the mining investment boom. The mining sector is starting to turn around, and that's one reason why Western Australia can afford to cut itself off from what they call the eastern states and still have its economy doing pretty well, because 35% of it's in mining and most of that shipped off at high prices to China. So they're all right. The other thing, of course, that's been helping to sustain economic growth in Australia, not just during the pandemic, but actually for the past 5 years, is government spending. And as the chart in the bottom right-hand corner shows, government spending has accounted for roughly half the growth in real GDP since the middle of 2015. And we're going to be relying on government spending to sustain economic growth for quite some years to come, I think we will see. Just looking at a bit more detail into that big 12% fall in consumer spending, you can see here that it was very much driven by a decline in expenditure, by very large declines in expenditure on a range of discretionary services, such as tourism, obviously, hotels, cafes and restaurants, transport services, recreation and culture. Health, you might think surprising, but what that captures is that a lot of elective surgery and other discretionary health spending was put on hold for the duration of the June quarter. In the goods sector, things like motor vehicles and clothing purchases were also down a bit, although they don't represent as big a share of total consumer spending as some of the other things that I mentioned. Of course, there were a few things where spending went up in the June quarter because people weren't allowed out of their houses. Many of them thought it was a good time to do a bit of renovation or handy person kind of work. So spending on that sort of thing went up. And as you can see, we also spent more on booze during the June quarter for reasons that are probably understandable as well. From an industry perspective, looking at the other side of the national accounts, you can really see which were the industries that copped it most. This is probably fairly well known. Again, tourism-related sectors like accommodation and food services, transport. You can see again the impact of cutbacks in elective surgery on the output of the healthcare sector. Manufacturing and construction weren't as badly affected by shutdowns as some other sectors, but because they're bigger sectors of the economy, the contraction that they experienced nonetheless did subtract meaningful amounts from the GDP growth in the June quarter. Your sector, finance and insurance, actually did have a small increase in real GDP in the June quarter, so it's at the other end of the table that I've shown there. Even as of mid-August, which is the latest data we have here, there's 75% of businesses are operating under so-called modified conditions. They're not trading as normal. And that's pretty uniform across really almost all of the Australian economy except for mining, where about half of all businesses are operating in what they would consider normal. It's also worth noting that the shutdown has actually had a bigger impact on big and medium-sized businesses, a smaller proportion of whom are trading as normal than it has done on small businesses. But of course, because government policy is very much focused on small business, and because although I don't think there's any evidence for it, government policy continues to think that small business is the so-called engine room of the economy, or maybe even because people on the coalition side of politics think that there's something inherently more noble about operating a small business than there is about working for a big one. Big businesses actually haven't been eligible for many of the programs of assistance that small businesses have been up for, and that might be why some very big companies have been more aggressive about permanently cutting jobs than most small businesses have been over the last 6 months or so. The most recent ABS survey also tells us that as of August, 40% of all businesses have lower revenue than they did in August last year. And you can see the distribution of that across different sectors of the economy. Also potentially worrying, 35% of businesses say they will have trouble meeting financial commitments over the next 3 months, which does underscore some of the risks that are potentially out there when the level of government assistance through programs like JobKeeper steps down, as it will later this month, and again from the beginning of January, unless there's something new in the budget. Obviously, one of the ways in which the crisis and the shutdowns have hit people has been unemployment. And conversely, one of the ways of tracking how the recovery is going is looking at how many people have been able to get their jobs back or to find new ones. More than 810,000 Australians lost jobs, according to the monthly labour force surveys in March and April. And the data that was out yesterday for August tells us that since May, about 460,000 or 53% of those have been able to get their jobs back or find new ones, although importantly, only 11% of those jobs have been full-time. So hours worked, which the Reserve Bank and others say is actually a better measure of underlying demand for labour than the actual number of jobs is, that's still well down on what it had been pre-pandemic. Hours worked fell at their worst point by about 7%. That's not nearly as bad as the Reserve Bank initially thought it had been, but they still haven't recovered to the same extent as employment has done. Of course, when people did lose their jobs in March, April and May, many of them dropped out of the labour force altogether rather than taking up the search for work. That could have been because they expected that they would go back to work eventually, as many of them have done, because they weren't allowed out to search for work even if they wanted to, or because they didn't feel there was any point. And bearing in mind that for a while, job seekers weren't actually required to look actively for work in order to qualify for the job seeker previously New Start benefit. That was probably another reason for the decline in the labour force participation rate that's shown in the third chart there. That has started to recover as people have been able to go back to work, and that has meant that the unemployment rate hasn't risen as much as you might have expected. The unemployment rate peaked at 7.5% in July. If people hadn't dropped out of the workforce, it would have been closer to 13% at the peak month in May. But even that measure has come down somewhat surprisingly. The official unemployment rate's now down to 6.8% as of August. If you included the folks who've dropped out of the workforce since the pandemic hit, then the unemployment rate would be about 9%. Of course, although people have gone back to work, many of them aren't working the sort of hours that they used to or they would like to. Underemployment is still quite high. And if you add people who are underemployed to those who are unemployed, then the so-called underutilisation rate of Australia's workforce is still pretty high at 18%. Now, that's down from the peak of 20.2% in May, but it's still higher, for example, than this measure was in the recession of the early 1990s, when the official unemployment rate peaked at about 12%. Of course, there are various government policy measures that are helping to keep down the measured unemployment rate. In Australia, unlike the United States or Canada, people who are classified as employed because they're still on an employer's books but haven't worked any hours, they might have been supported by JobKeeper, they're counted as employed in Australia, whereas in the US or Canada, their statistical agencies regard folks in that position as unemployed. If you measured it the way the Americans do, then our unemployment rate would have been rather higher than it actually is. It would have been as high as 14.5% at the peak back in April. It would still be about 8.3% today if you measure it in that way. If we look by state, and not surprisingly, Victoria has had the roughest experience of the coronavirus shutdown. That's because they really only had a small window during June when people could go back to work, and more of them have been thrown out of work since. Of the other states, Tasmania, Western Australia, the ACT and New South Wales have had the strongest recoveries in jobs and the smallest increases on net in unemployment. Looking at what might be happening beyond the end of the June quarter, the NAB monthly business survey, which is well respected by the Reserve Bank and other commentators as giving a pretty comprehensive and timely read in economic conditions, that showed quite a strong recovery across most of its major components in July, but almost all of those gains were given back in August, and not only because of Victoria. There were also declines in other states, particularly New South Wales and Queensland. Western Australia, which is driven by the mining sector, was much less affected, of course. But businesses in other states were worried that what was happening in Victoria would have direct consequences for them, which for many of them it did, or about the possibility that what Victoria had experienced could, if by bad luck, be replicated, say, in New South Wales or Queensland. In particular, notice that the forward-looking parts of the NAB survey, employee hiring intentions and capital expenditure intentions, are still pretty weak by historical standards, which underscores my point that the recovery, as and when it gets underway, is going to be a lot more gradual than the path into this downturn actually was. Retail sales have done pretty well since the big plunge that we saw in April. In fact, in level terms, they are now higher than they were going into the pandemic, and that's particularly true if you exclude Victoria from the overall calculation. Motor vehicle sales are still pretty weak. They had a big rebound in the last few weeks of June, partly because of people wanting to take advantage of the instant asset write-off, partly because motor vehicle dealers were offering some pretty juicy deals to would-be buyers in order to clear their inventories, reduce the amount of stock they had on their sale yards. But again, helped by a 55% slump in Victoria in August, overall retail sales of motor vehicles aren't much higher than they were at the bottom in April when that occurred. To the surprise of many, property prices have held up pretty well since the pandemic struck. On average, they're down 1.3% from April to the end of August. But important to note, that's been on pretty thin volumes, and a lot of folks who might otherwise have had to sell their properties have been able to avoid doing that because of the repayment holidays that banks have granted since March, and which in most cases they're probably going to be extending for another 4 months or so. About 11% of mortgage customers across Australia have taken up the offer of a repayment holiday. At one point it was 13. Some people have started to resume repayments. Quite a lot of people who haven't been repaying loans have nonetheless been building up their mortgage offset accounts. But nonetheless, I would expect that there will be some people currently owning their homes who haven't needed to service their mortgages, but when that runs out and they have bigger mortgages to service, which they will because interest has been capitalised, it hasn't been forgiven entirely, some folks probably will have difficulty meeting their commitments, especially if they either haven't gone back to work at all or haven't gone back to work earning the same wages, because they're not working the same hours. So I wouldn't be surprised if we did see some downward pressure on property prices later on when the market becomes a bit less artificial. I'm not one of those who thinks that property prices could fall by 20 to 40%, as some forecasts have said, but I wouldn't be surprised if they fell by 10% or a bit more, as of course they did in Melbourne and Sydney between mid-2017 and mid-2019. Of course, as people who are in these markets will know, in places like Perth and Darwin, they fell a lot more than that. If we just look across the country, we can see that the places that have fared worst during the pandemic in terms of property prices have been regional WA, Perth, Melbourne and Sydney, whereas in a few places, including Adelaide and down here in Hobart, property prices have actually continued to go up. Of course, one of the big headwinds that the property market will face, and indeed the housing industry more broadly, is the absence of immigrants, given the closure of our international borders. Immigrants, in effect, account for more than 80% of the demand for new housing year in and year out, and that's just simply not going to be there until the second half of next year. And even when, as I assume, the government does open the doors to international movements of both visitors and migrants, the government's probably going to keep the immigration intake lower than it was beforehand, because there'll still be plenty of Australians looking for jobs at that time, and it won't go down too well with voters if lots of immigrants are allowed to come in to compete with Australians for that. So although the housing industry has held up pretty well so far, and some of the schemes that the federal and state governments introduced a few months ago to encourage people to sign up for building new homes have had some impact, the housing industry is really being supported by the pipeline of work they had on projects that hadn't been finished when the pandemic struck. As that wears off, and notwithstanding that there might be some spikes in new home sales spurred by government subsidy programs, I suspect that the residential construction industry is going to be in for a pretty torrid time of it over the next 12 to 18 months. More broadly, business is going to be very cautious about new investing. Normally, the surveys that the ABS takes of business capex intentions every 3 months show them being progressively revised upwards as more is known about the financial year that's either approaching or underway. But as you can see from this chart, since the first survey for 2021 was taken early this calendar year, businesses have been moving sideways or revising down slightly their plans for capital expenditure over the course of the coming financial year. And of course, the biggest single factor behind that is uncertainty about the future state of the economy, which is nominated by 60% of respondents to an ABS survey on that, or related to it, future customer demand. And who could blame any business for being uncertain at the moment about the future state of the economy or about expected future demand? You know, uncertainty about the longevity of government support programs would be another thing that would be making businesses hesitant about committing their own money or their shareholders' funds to major investment projects. Fortunately for Australia, the prices of most of our key resources exports, and especially iron ore, have held up pretty well. You might remember during the global financial crisis, all these commodity prices tanked, although they then recovered on the back of a mega stimulus by the Chinese government. Well, the Chinese government isn't doing a mega stimulus this time around. I think they feel they got burnt by the effects on credit quality and on the health of their banking system of some of what they did after the financial crisis of 2008-9. The main reason why iron ore prices are holding up as well as they are, as I'll show you in a moment, is that China's own production of iron ore is continuing to decline, and our major competitor Brazil has got some problems of their own, which means that Australia's big iron ore producers have almost been able to name their own price. Most other resources exports have also held up pretty well, but agricultural commodities, on the other hand, haven't, and in particular wool prices in recent weeks have been at their lowest since November 2009. Fortunately, Australia doesn't ride on the sheep's back nearly as much as it used to, but for those parts of Australia's economy that do ride on the sheep's back, it's not been a particularly pleasant ride at the moment. As I mentioned, the main reason for the resilience in iron ore prices has been that China's own production has fallen a lot, and because Brazil has had tailings dam collapses at some of its major iron ore mines and outbreaks of COVID-19 at some of its others, its production has been significantly curtailed over the last year or so. Brazilian production will start to come back over the next 6 to 9 months, and that will probably see iron ore prices start to move downwards. Over the longer term, China's efforts to diversify its supplies of iron ore away from Australia to places like West Africa, and eventually its ability to produce steel from its own scrap rather than having to produce new steel from iron ore and metallurgical coal, will mean that by the end of this decade, iron ore prices will probably be down to somewhere like $50 a tonne, if not less than that. But in the meantime, the going for iron ore producers has been very good, and they've been enjoying it. Partly because of the resilience of iron ore prices, Australia has run pretty substantial trade surpluses in recent months, although it was down quite a bit in August. That was partly because of the impact of China's reduced purchases of other commodity exports, which we've seen starting to take the news headlines. Of course, the other thing that's contributed to our large trade surpluses has been the collapse of tourism. Most media commentary focuses on the fact that no tourists are coming here, which is true, but because since the early 2000s, more Australians have gone overseas than foreigners have come to Australia. What's really actually mattered has been that no Australians have been allowed out, unless you're Tony Abbott wanting to get a job from the British Prime Minister. You can't get permission to go overseas to farewell your dad, but if you're Tony Abbott, you can. Anyway, the fact that Australians haven't been allowed to go overseas has done more for our services trade balance than the fact that foreigners haven't been able to come here. And that's actually resulted in a situation where Australia's been running an overall balance of payments surplus in recent quarters, which we haven't done since the mid-1970s. Inflation turned negative in the June quarter, although that doesn't mean that Australia's about to experience deflation of the sort that we did in the 1930s. The main reason why we experienced negative CPI inflation in the June quarter was because the government made childcare free for most of it, which showed up as a 99% fall in the price of childcare on average for the quarter. And we also had petrol prices falling by almost a fifth, which between the two of them subtracted almost 2 percentage points from CPI inflation in the June quarter. However, as we know, childcare is no longer free, and the price of petrol at the pump has rebounded somewhat since the end of the June quarter. So both of those items are going to be adding positively to inflation in the third quarter. Underlying inflation, which looks through big swings on the margin like this, was flat in the June quarter, and it's now been below the Reserve Bank's target for more than 4 years. And it's going to be a long time, as the Reserve Bank acknowledges, before it gets up there. Of course, we look at some other prices, including the price of food and other essentials, that has gone up during the pandemic because demand for it has been so strong. Also serves as a reminder, I think, that however horrible economic conditions might be, the chance of us falling into 1930s style deflation or to the sort of ongoing but mild deflation Japan has had for most of the last 30 years is, I think, relatively small. The currency crashed in the early part of the financial crisis, as it did in the early part of this pandemic, as it did during the global financial crisis, but partly thanks to that action by central banks I mentioned earlier. More importantly, because the US dollar has fallen and because the iron ore prices headed back up to near record highs, the Australian dollar has rebounded very strongly. A week or so ago, it was over 74 cents. It's still around 72 cents. I suspect as the iron ore price comes off, as it will over the course of the coming financial year, currency will head back into the mid-1960s, unless, of course, the US dollar takes a run downwards, which it could do if Trump is re-elected or if the Federal Reserve decides to embark on some more extraordinary monetary policy stimulus. But otherwise, I'd be surprised if the currency goes much stronger than it has done in recent weeks. Let's have a look at the response of the Australian authorities to all of this. When it comes to the budget, the Australian government has been amongst the more generous of governments around the world in terms of the support they've provided to households and businesses to get through this crisis. The focus so far has really been on maximising the survival prospects of businesses affected by shutdowns and minimising the impact of those on employment, whilst also providing more generous support to people who've lost their jobs than has traditionally been the case, especially, I suppose, to people in middle-class occupations who've never had any previous experience of being unemployed. The government's been concerned to make maximum use of existing administrative mechanisms, unlike some of the things that the Rudd-Gillard government did during and after the financial crisis of 12 years ago, which is why we have the sort of schemes that we have. These measures have also been designed to be fairly easy to switch off once the need for them has passed, rather than rolling on long after the need for them has passed, as could be said of some of the measures that were introduced during and after the financial crisis of a decade ago. The consequence of all of this has been, of course, that the budget deficit has blown out to hitherto unthinkable numbers. We know that the deficit in the financial year that ended in June was $86 billion. The most recent forecast is for it to widen to almost $200 billion, or 10% of GDP in 2021. That would be the biggest as a proportion of GDP since the end of World War II. In fact, when the Treasurer brings down his delayed budget on the 6th of October, that number will almost certainly be revised higher, possibly to over $200 billion in the current financial year. And based on projections by the Independent Parliamentary Budget Office, net debt will probably peak at $770 billion, almost 35% of GDP in 2023. And we won't return to surplus until the financial year 2027-28 at the earliest. Again, I'd expect in the budget to be brought down in a couple of weeks' time, those numbers to look even worse and to be projected out further, the return to surplus to be projected out further. I should say in passing that while net debt of 35% of GDP is high by our recent standards, it would still be very low by comparison with most other advanced economies, many of whom are going to have net public debt in excess of 100% of GDP for the foreseeable future. There's no need for alarm at this seemingly dramatic increase in the level of debt. Australian governments have coped with much higher levels of gross debt as a proportion of GDP in the past than are in prospect over the next decade. And because interest rates are so low, governments actually won't be spending humongous amounts servicing that debt. Indeed, in the July economic and fiscal update that the Treasurer presented, the forecast for interest payments on government debt as a proportion of GDP in the financial year we're now in was lower than it had been in any year between 2013-14 and 2018-19. Nor is the government having any difficulty at all raising the money it needs to finance these deficits. The Australian Office of Financial Management, which is the body that actually conducts the borrowings on behalf of the government that it needs to finance its deficit, has been swamped with people wanting to lend money to it. For every dollar that they've actually borrowed since the 31st of March, they could have borrowed another $3.50 at interest rates that would have been just 3 basis points, that is 0.03 of a percentage point higher than the interest rates which they actually paid. Investors are, as I say, literally falling all over themselves to lend money to the Australian government, in part because there aren't as many other people that they would want to lend money to during this period. Now, of course, on current policy settings, this massive fiscal stimulus is set to unwind quite dramatically from the beginning of the December quarter and then again at the beginning of the March quarter next year, as JobKeeper in particular is wound down. The level of job seeker payments is reduced, and the eligibility criteria around both of those programs is significantly tightened. Inevitably, the government will need to, and almost certainly will, provide more fiscal stimulus than is currently provided in budget estimates in the budget that the Treasurer will be bringing down on the 6th of October. Businesses are telling the government that premature withdrawal of support will have significant consequences for the economy and for individual businesses unless the government delays that until the economy is much improved. You can see here, for example, the survey that was taken in July that says that businesses who are currently accessing support measures will, for example, 30% of them will start sacking workers if support is no longer available. Or indeed, something like 25% of businesses say that they will close down altogether if support is withdrawn prematurely. The government knows this, of course, and it's something they'll take into account in terms of framing what they do. The Treasurer has given pretty clear signals that what he wants to do is to bring forward the income tax cuts that were taken to the last election and which following the election were put into LAW, law, to coin a phrase. Those tax cuts do inevitably favour people on middle to high income earners because, of course, they're the ones who pay most of the tax. In Australia, it's actually hard to cut income tax without it favouring middle to high income earners. And the Treasurer is right when he says that bringing forward those tax cuts will put more money into people's pockets. Of course it will. The problem, as I see it, is whether those people will actually take money out of their pockets and put it into the economy in ways that will support businesses and save jobs. And the history isn't all that compelling on that score. If we look at the income tax cuts that were passed even predominantly to lower income earners in the September quarter of last year, most of those were saved, as of course was a big chunk of the income that governments threw at people during the June quarter, as I showed you earlier. And that suggests that there are probably more effective ways of boosting the economy and supporting businesses and jobs than income tax cuts. And one of my favourite suggestions is that the government should provide vouchers for example, tourism, or alternatively could be things like childcare or other medical expenses, which could only be cashed for spending in those areas, would expire worthless if they weren't spent by, say, the June quarter of 2022, and which could be sold if people who got them for some reason found that they couldn't use them by the day on which they became worthless. That would, I think, guarantee that the money got spent, that money got spent in the areas where it was most needed, and that it wasn't saved. But I suspect the government isn't going to do that. They will do some additional infrastructure spending. I agree with the Governor of the Reserve Bank who says that dollar for dollar, it's probably better to do a large number of small projects that can be spread widely around the country and which can be dialed up or down depending on how well the economy is tracking or not, or can be redirected to those parts of the economy which appear weakest, rather than big ticket items, which almost by definition can only be undertaken in a handful of places. Again, we'll have to look to see whether the budget delivers on that, or, as I say, is predominantly takes the form of bringing forward personal income tax cuts. At the state and territory level, there's been considerable variation in what governments have done. The Tasmanian government has been far more generous than any other state or territory in the support that it's provided to businesses and households through this pandemic, partly because it could afford to, not having run up as much debt as some other state governments have done over the past 5 years. Not that being parsimonious has actually hurt governments. Look at Western Australia, for example, has done less than the average of other states and territories to support businesses and households through this, but the Western Australian government is the most popular of any government in the country, with the Premier having an approval rating over there of 90%. As far as the Reserve Bank's concerned, like other central banks, it's broadly done as much as it can to support economic growth. It's cut its cash rate to as low as it thinks it can. And even though the target's been set at 22.25% since March, it's actually allowed the cash rate to drift down to half that. And it said that it'll probably be at least 3 years before they start to think about returning interest rates to more normal levels. They've backed up that commitment by buying government bonds in the secondary market with a view to keeping the 3-year yield at 0.25%. And that in turn has helped the banks to cut the interest rates they charge on fixed rate mortgages and business loans to record lows. The Reserve Bank, when necessary, has provided additional liquidity through its open market operations to support credit markets, and it's provided up to $58 billion of 3-year funding at 0.25% directly for banks to on lending to businesses, especially SME customers, through its term funding facility. And last, at this month's Reserve Bank board meeting, it announced that that facility will be extended through to the 30th of June next year, and that potentially up to $200 billion might be available through it. These measures have been successful in keeping long-term interest rates down as well as short-term interest rates. The Reserve Bank doesn't have much appetite for taking interest rates into negative territory, as, for example, the New Zealand government, and yesterday it seems the Bank of England are thinking of doing. It doesn't want to pursue so-called modern monetary theory. That's the Kool-Aid that Alan Kohler, the ABC's business commentator, seems to have swallowed, this idea that you can just print money to pay for government spending rather than borrowing it or raising taxes to pay for it. As it happens, I don't think that if they were to print money in current circumstances, that would result in the sort of inflation that has become famous in Zimbabwe or more recently in Venezuela, which of course was part of what brought Hitler to power in Germany in the 1930s. That probably wouldn't happen, but the problem is that once governments got addicted to the idea that you can spend money in ways that win you votes without having to pay it back through borrowing or annoy other people by increasing their taxes, you'd never wean them off that. And eventually you would run into inflationary problems if and when the economy returned back to more normal levels. Let's talk quickly about the path out, and then hopefully there's time for a couple of your questions. As I've said, the path out of this will be more gradual than the path into it was. Not only because restrictions are going to be relaxed gradually rather than all at once as they are imposed. I mean, we know that restrictions on the movement of interstate people across state borders has been restricted, even though in Western Australia, Queensland, South Australia and Tasmania, people have been able to go about most other aspects of their business. Restrictions could be reimposed, and of course restrictions on international travel are going to remain in place probably until the middle of next year. But even apart from that, we know from looking at other countries that people are going to remain wary of exercising all their newly regained freedoms even when restrictions are removed. Again, a helpful survey the ABS undertook in August told us that people are going to continue taking precautions against the possibility of catching the disease. People are happy to go back to workplaces, they're happy to send their kids back to school, they're happy to go and see a health professional rather than doing it by telehealth once governments say they're allowed. But even after that, people are going to be reluctant to use public transport or to catch planes. They're going to be reluctant to go to large public gatherings until such time as a vaccine, I should say, is discovered, or until such time as daily infection rates are really at very low levels that suggest the risk of community transmission of the virus is zero. So even if all restrictions were to be lifted tomorrow, I suspect that you would still see people being much more cautious than they were before we'd ever heard of any of this stuff. In addition, of course, we know that some businesses won't have survived the shutdown, and that most of those who do won't return immediately to pre-outbreak levels of employment. So employment's only going to recover slowly. Those who do go back to work, as we can see from the figures already up to August, will be working fewer hours in most cases than they were before the pandemic. And so they'll be earning less money, which is one reason why the recovery in household spending is also likely to be gradual. Among other things, households who've run down their savings accumulated during the shutdown will want to rebuild them. People whose superannuation balances were smashed up by the falls in the share market earlier during this might want to save more in order to rebuild their retirement incomes, as they did during and after the global financial crisis. Those households who've deferred repayments of their mortgages are going to face higher payments or payments over a longer period when they do start servicing their mortgages again. And of course, that means that they can't spend as freely as they once did. And if property prices do fall when the market opens properly, as I suspect they might, then we might see some of the negative wealth effects on household spending that we did in most of Australia when property prices were last falling as they did on the East Coast between late 2017 and mid-2019. As I mentioned before, despite the recent extensions to JobKeeper and JobSeeker payments, the fact that those payments will be stepped down quite significantly at the beginning of the next quarter and the beginning of the March quarter means that there will be an effective tightening of fiscal policy at the beginning of each of those quarters, which will probably detract from economic growth. I've mentioned that tourism will remain in the doldrums until a vaccine is widely available and governments can feel that they can open their borders. And of course, for the reasons I mentioned before, businesses are going to be very hesitant about spending theirs or their shareholders' money on capital projects for an extended period. Thinking more broadly, Australia's strong economic growth over the last 20 or 30 years owes a lot to factors that I don't think will be there in the immediate post-COVID period. One of those was, of course, our above average rates of population growth driven in turn by our immigration program. Over the last 20 years or so, Australia's population growth has averaged a percentage point per annum more than the OECD average. If our population growth had been the same as the OECD, we would almost certainly have had one, and possibly two, recessions in the conventionally defined sense of that term during the last 20 years. And in fact, if you take out population growth, our per capita economic growth performance since the end of the mining boom has actually been below the OECD average rather than above it. A second major contributor to our strong economic growth over the last 20, 30 years has been our peculiar relationship with China. I say by peculiar, I mean by way of contrast with most other Western economies. Most other Western economies are exporters of manufactured goods and importers of commodities. So what China's been doing in terms of becoming the manufacturing export warehouse of the world has been at the expense of other developed economies. And what China's been doing in pushing up the price of the commodities that China imports has also been harmful to other Western economies like Japan and Europe, which import a lot of commodities. As I say, we're not like that. We're an exporter of commodities and an importer of manufactured goods. So we've actually benefited from what China has been doing over the last 30 years in a way that few other Western economies have done. We're one of the very few Western economies that runs a surplus in its trade with China, just as we're one of the very few countries that runs a deficit with the United States. That's one reason why Donald Trump hasn't been as rude to us as he has been to most of America's other trading partners and allies, because Trump views trade as being fair or unfair, not according to what countries actually do, but according to whether the US runs a surplus with them or not. So he must think we're great at cheating on the Chinese, but he's able to get away, he would say, with cheating on their trade with us. The point of all of this is, of course, that we're much more vulnerable than other countries to any decoupling of our relationships with China, or any attempts that China might make to want to punish us for having, as they would say, offended the feelings of the Chinese people for saying something that the Chinese Communist Party doesn't approve of. China's trade actions against our barley, beef, wine and coal, and their threatened actions against our students and tourists, or their tourists and their visitors to Australia, aren't justified. We haven't done anything really that warrants that. But we're not Snow White either when it comes to harassing foreign journalists or indeed to trade measures. Australia, perhaps surprisingly, is the 5th biggest user of anti-dumping measures in the world over the last 5 years, even though we're only about the 16th biggest economy in the world. And we've taken far more harmful trade policy measures over the last decade than we have done liberalising ones, and more of them have been directed against China than against any other single country. So, well, as I say, that doesn't justify what China has done. We're not exactly Snow White when it comes to trade policy either. And then the third thing that helped sustain Australia's rapid economic growth over the past 30 years was, of course, our housing boom and the increase in household debt that was both a cause of it and a consequence of it. I really hope that we don't see a repetition of the extraordinary gains in house prices fueled by extraordinary increases in household debt that were so much a characteristic of the last 30 years, apart from the fact that that would make us more vulnerable to any kind of external shock, especially one that resulted in higher interest rates. I don't want to see a repetition of the decline in home ownership rates that has occurred over the last 30 years, which has resulted in the home ownership rate among people under the age of 45 at the last census falling to its lowest level since the census of 1947 and exaggerating intergenerational inequities in the distribution of wealth within Australia. Looking at it at a different way, we're going to have to do much better in terms of promoting productivity growth in the post-COVID world than we have been in the last few years. Between the early 90s recession and the onset of the global financial crisis, roughly speaking, a bit over half of the growth in our economy came from increased productivity, and a bit under half of it came from increased labour supply. That is, more people working or more people working more hours. Whereas in the 5 years since the end of the mining boom and before all this started, almost 3/4 of our economic growth came from more people working or more people working longer hours, and barely more than 1/4 of it came from productivity growth. In the long run, as every economist knows, productivity growth is the only sustainable source of improvements in people's living standards. And if we want to have improvements in people's living standards over time, bearing in mind that we're not going to get them from China paying ever higher prices for ever greater amounts of our iron ore, coal and gas. We're probably not going to get them, I hope we're not going to get them, from ever increases in the prices of the real estate that we already own. We're going to have to get it the harder way from improvements in productivity. And I don't want to repeat that chart again, so I've already shown that one. That's the end of the presentation. Let me say that if you're interested in these charts, you can get a weekly update of them and many others, including those on individual economies, or you can participate in monthly webinars I run through my website, and you can go to bettercallsaul.com.au for more details of how to do that. Stephen, I've been talking for longer than I was probably meant to, which I seem to have a habit of doing, but maybe now if there's time for people to ask questions, I'd be very glad for that to happen. Thank you.
Yeah, thank you very much, Saul. That was really insightful. We do have a moment for probably a couple of questions. I know we have gone over time, but if that's okay with you, let's
Absolutely.
let's start at the top. So we've got a question from Richard, and it's about how do you see the CBD activity, commerce, tenancy, hospitality changing compared to regional centres over the coming months? And do you see a population explosion in regional areas to the detriment of the metropolitan?
That's a good question. I think it's inevitable that the CBD-centric model of the services economy that's come to dominate our big cities over the last, say, 30 years has faced a fundamental challenge in the last 3 months. And that from both the perspective of employers and employees, we're not going to go back to the way that was. There are obviously some things that can't be done other than in offices. But I think a lot of people who work in offices have discovered that it's a lot nicer not to have to spend an hour or more at each end of the day commuting from where you can afford to live to where your boss's office is. And I think a lot of employers have discovered that their people can actually work effectively, either on their own or in teams, using technology like the technology we're using today. Now, it's not a perfect substitute, and almost all service providers will need to have their employees face-to-face with them for some things. And as I say, there are some activities that can't be done other than face-by-face. But I suspect we're going to see quite a significant proportion of work no longer being done in high-rise CBD offices, which some people I know are referring to as vertical cruise ships because of the risks that are potentially faced by people who work in them of catching a nasty virus. I mean, the vaccine, when we get it, will probably cause another rethink about that. But still, when you think about the amount of time that all of us have been, or those of us who work in CBD offices have been wasting on trains or in traffic or on buses, getting to and from work. There's time that we could have spent working, or time we could have spent with our families, or time we could have spent playing golf, or however we want to do it, that's more fun than sitting in traffic or standing up in crowded trains. That's going to change the way people think about the world of work. That means that, you know, more work will probably be done from suburban homes, but it's also an incredible opportunity for places in regional Australia to tempt businesses or parts of businesses away from our bigger cities to set up in other areas that don't have everything that the big cities have to offer, to be sure, but are able to offer ways of life that you know, may not produce all the dollars that living in big cities like Sydney and Melbourne does, but have other less tangible things that offset that. And, you know, sitting down here in Hobart, as I have been down for the last 5 years, I really get that. And I think more people in other parts of the country will probably get it as well. So it's a fabulous opportunity for regional Australia to reverse some of the population drift that has been occurring to Australia's bigger cities over the last 30 years. Not every city is going to be able to do it, or not every regional centre is going to be able to do it. Some are just too far away from where the action is to be able to do it. Governments could think about this as well in terms of the infrastructure that they provide to people in regional areas, including, in particular, high-speed broadband and mobile phone, where the reception doesn't drop out every 20 minutes. That's important. The availability of air services to major centres at reasonable prices is another thing that would help facilitate businesses setting up and employing more people in regional areas. But I think all of this is much more doable in the post-COVID world than people have thought it could be prior to the onset of the pandemic.
I think you answered another question was on the similar lines, but still on the housing market, just quickly, do you think we've bottomed out, or prices likely to rebound in the medium term?
No, I don't think we have bottomed out, Stephen. As I said before, there's at least 11% of people with mortgages who haven't been servicing them over the last 6 months. Some of them, you know, could have done and have chosen not to, and have been building up their mortgage offset balances instead, which is fine. But there's going to be a proportion of that cohort of people who haven't been servicing their mortgages who, when the bank's patience runs out, will not be able to meet their larger or longer commitments, and either they will conclude that the right thing to do out of an unpleasant set of choices is to sell, or the banks might make that decision for them. And, you know, if they haven't returned to work at all, or if they haven't returned to work on the same pay they had beforehand, then there are going to be folks who are thinking about that. So that's one potential source of downward pressure. The other one is that, you know, a big part of the demand for housing over the last 30 years has come from immigrants coming to the country. And there aren't going to be any of those until the middle of next year, probably. And even when after then there will be some, there almost certainly won't be as many of them as there used to be, because the federal government isn't going to let them in the same quantity while there are still Australians who are looking for work. And even over and above that, there's also the question of interstate migration, which, for example, has been very important for Melbourne, has been important for Tasmania in terms of boosting property prices. It may be that more people will want to come to Tasmania because we've had a pretty good run of handling the pandemic. It may well be that more people will want to go to, say, South Australia or to parts of Western Australia that have done pretty well in handling the pandemic. But I suspect fewer people will want to move to Melbourne from other states because of what happened there. And as I say, the strength of Melbourne property prices has owed a lot to migration from other parts of the country as well as from overseas. So as I say, I think although the property market has been surprisingly resilient over the last 6 months, I would still think it's more likely than not, when the level of transactions returns to something more normal, rather than being artificially low as it has been over the last 6 months, that we'll see prices more likely fall than rise. As I say, I don't believe we're going to see catastrophic prices of the sort that some people have been talking, 30, 40%. I don't believe that, but I wouldn't be at all surprised if we saw something, either side of 10%, for example, over a 6 to 12 month period.
Taking the other view, do you think Australia, another question, going the other direction, if we have if COVID goes away, do you think Australia could face a boom, or as COVID cases decline and students and immigrants see it as more of an appealing option?
Well, I can't imagine that we would be in that position on our own. In other words, you know, if by some chance, you know, well, I suppose if a vaccine is found and it works, you know, it'll work for other people as well as it works for us and vice versa. So, you know, other people will have the same opportunities in front of them that we do as a result of getting on top of the virus. I find it hard to believe that in the absence of a virus, we would come up with some way of defeating the virus that other countries weren't able to as well. So again, I don't think we're going to be uniquely placed. It could be that because, to go back to something I said earlier in the presentation, despite the second wave in Victoria, we and New Zealand have done pretty well by contrast with North America and Western Europe in managing the virus, that more people might think as Australia is a safe place and want to come here. But whether our government lets them do that is another question. I mean, yeah, it was starting to become an issue before the panic that high levels of immigration were contributing to deteriorating housing affordability and congestion on the roads and other things like that. And you know, those concerns will resurface if immigration picks up quickly in the aftermath of the pandemic. And as I say, if, as may be possible, when restrictions on immigration are lifted, there are still lots of Australians who are looking for jobs or looking for better jobs, then you know, the simple politics of it says that the government isn't going to let 200,000 people a year in as new citizens, that they will exercise greater control over that.
I know we've got a couple of questions more, I think, if that's okay.
Yeah, sure.
Just quickly. One is, do you think this will change the global economy in terms of like greater development and reliance on national production rather than trade? Yeah.
Well, the answer is yes, but that worries me. So yes, I think it's understandable that governments will, as a result of this crisis, want to have greater confidence in the security of supply of a number of essential or strategic items. And, you know, we kind of learnt the hard way that there are risks associated in having all our PEP or medicines coming from one place in China. And given the deterioration in the political relationship with China, which I think is a long-term thing, you know, there's another dimension to that as well, that, you know, if we find ourselves in a more serious conflict with China, then China could just cut off the supply of things on which we rely. Or, you know, they could do things in the South China Sea that stopped us importing stuff that we need from other countries, even if they're our friends. So, you know, I kind of get that. But I do worry that it could be used as an excuse for more insidious forms of protectionism that are always there. And what I would say is this, that replacing a foreign supplier with a domestic one doesn't necessarily mean that your supply is more secure. I mean, suppose we were to replace the imports of widgets that we get from a single factory in Wuhan by subsidizing the establishment of a factory to produce widgets in Brisbane. Would we really be more secure in our supply of widgets the next time there's a big flood in Brisbane? Or suppose that the government were to subsidize the establishment of a factory producing something else in a marginal National Party electorate, which I'm sure there are National Party members arguing that they should do. Would that really guarantee a more secure source of supply the next time there's a great big bushfire in that part of National Party territory? And of course, the answer is no. So, you know, while you can see a role for domestic production of some things as being part of the answer to the quest for greater security, what we actually need is more diverse supply lines of products. That is, you know, a mixture of imports from places other than China, as well as just simply assuming that we can produce all of this stuff ourselves and produce it at a quality that our consumers will regard as adequate and at a price that our consumers can afford. Because you can bet that there will be people who will be saying to the government, you know, you should really subsidize us so that we can guarantee you a supply of stuff that's Aussie made. They won't be doing that out of charitable or patriotic motives. They'll be looking to make a buck. And that's their job. I mean, I'm not criticizing anyone who wants to make a buck, but it's not the government's job to hand over taxpayers' bucks to anyone who thinks they can make one. And so we need to think carefully about this. It shouldn't be an excuse to return to the sort of world Australia lived in between Federation and 1989, when we kind of conned ourselves into thinking that we were good at manufacturing by forcing Australians to pay inflated prices for what were usually badly made goods. And you only have to look at cars to see what Australians really thought of that. I mean, you know, for all that we thought, you know, cars that were actually built by foreign-owned companies like Holden and Ford and Chrysler and Nissan, you know, there was something Aussie about them. As soon as Australians were given the chance to buy foreign-made cars, usually of better quality, at lower prices, and actually designed to meet what Australians wanted, like being more fuel efficient, well, then they did it. And, you know, as I say, I understand the desire for greater security of supply in some things, but it shouldn't be used as an excuse to bring back the protectionist system that saw Australia go from being the richest country in the world in the first half of the century to being on the way to what Lee Kuan Yew used to call the poor white trash of Asia and only about 21st in the world by 1990.
Last question, if that's okay. It's basically, you seem relaxed about Australian government debt. But what about US government debt, which is very high, and they've got low relative taxes? Will they ever get out of that exposure?
Well, again, I would say as a matter of principle that while the US has a lot more debt than we do, and so does the UK, and so do most, I mean, Japan has public debt of over 200% of GDP. That's more than Italy and double what the US and the UK have, yet that doesn't seem to have done them a great deal of harm. Japan has got problems, to be sure, but more of them come from falling population growth than they do from high levels of public debt. So, or falling population, I should say, not just falling population growth. Governments are not households. You know, households, individuals want to pay off their debt before they die because they don't want to leave debts that their children have to pay. They'd rather leave them assets if they can. But governments don't die. I mean, governments change, of course, at elections in countries where they're allowed to have elections, but governments don't die. And it's not as if, you know, people who hold government debt at the moment won't be able to collect it at some point in the future. I mean, governments may borrow from someone else in order to repay someone who's got a maturing bond, but they can do that. The US has been around since 1776. There has not been a year since 1776 in which the US hasn't had some public debt. There hasn't been a year since 1693, when the Bank of England was founded, in which the British government, whatever it's called itself, hasn't had some public debt. There have only been 8 years since Federation when the Australian government hasn't owed some public debt. And if you go back to, you know, colonial governments, you know, there hasn't been a year probably since 1788 when the New South Wales government hasn't owed some public debt. The question is, can you service the debt which you have at the interest rates you have to pay out of the tax revenue that you're able to collect while still providing the public services that your voters expect you to provide? And for as long as interest rates remain relatively low, which I think they will for, you know, the next 5, probably 10 years, then, you know, we don't have to worry too much about that. You know, none of that's an excuse for being silly with debt, you know, for borrowing money just because you can and spending it on boondoggles for which there is absolutely no business case, you know, or just throwing large sums of money at people in order to buy their votes at the next election. There's no excuse for doing that, whether interest rates are 10% or 0.001%. But, you know, there are more important things we have to worry about for the foreseeable future than the level of debt. And for as long as the rate of growth in the economy is higher than the rate of interest on the debt which we have, then we can cope with the debt that we have. And the focus for the near term, I think, ought to be on maximising the rate of growth in the economy, because that's what's going to keep businesses afloat and provide the sort of environment in which people can start new businesses and expect them to grow. And it's the sort of environment in which those of us who don't run businesses or start them can reasonably expect to have jobs that pay us decent wages.
I'm sure we could go on for a very long time, and thank you very much for answering those questions and for the detail you went through in those slides. it's a shame we had to cut it off there.
But people can see more at my website if they want to.
That's right, and we encourage you to do so. And once again, thank you very much, Saul, for doing this for us, and appreciate all the members who were able to attend today. So without further ado, let's call it an end. So thank you very much.
Thank you. Good afternoon, everyone. Have a good day.
Bye.